A gap is an empty space between two candlesticks where the price either rises or falls from the previous candle closing with no trading occurring in between. They also represent big supply and demand imbalances where either supply exceeds demand or demand exceeds supply. When trading supply and demand, gaps are great indicators of market imbalance. In general, levels with gap are considered to be the strongest levels to trade because they are high probability zones. Now the price can be either gap up or gap down. Gap up is a gap that occurs when the lowest price of the candle is above the highest level of the previous candle, and a gap down occurs when the highest price of a candle is below the lowest price of the previous candle. Like we can see in the chart, this is a gap down and this is a gap up. Gaps are common when a major economic event causes market fundamentals to change during the weekends when the market is closed. They are usually found at the open of markets on the next working day. A gap is considered closed or filled when the price comes back and fills the entire range of the gap. Like we can see on the chart, this candle low has gone below the high of the previous candle. Once price fills the gap, it reverts to the direction of the previous trend. There are mainly two kinds of gaps: professional gaps and novice gaps. A professional gap is a gap that occurs in the opposite direction of the previous trend. Like here we can see price has opened gap up and the trend before that was down. The professional gap are formed at the beginning of the moves and extend it, where a novice gap is a gap that occurs in the direction of the previous trend. A novice gap tends to form at the end of the move, signaling a potential trend reversal. Normally novice traders buy at this area. They see that price has opened gapped up, breaking a resistance, and they buy at that area thinking that it's a breakout, and the next day we can see a red candle and all the novice traders get trapped. Whenever we are buying at novice gap, we are trading against the professional traders. It is important to understand these two types of gaps when trading supply and demand, because when they happen, they give us an important piece of information as to where the market is willing to go next.